Good morning, everyone. It is 6 a.m., half an hour before the market is going to open on July 8th. Last week was a holiday week. It was mostly quiet, but on Friday we did get some excitement towards the end there where basically we made all-time highs and we had a quite a surge moving upwards. So we'll take a look at that in context, see how significant it is, and then see if that fits in the non-random uh, category and what we can expect for the rest of this week. So we'll start out by taking a look at Friday and see what happened there. And see that it went up, and actually it didn't really move all that much more than it did the previous day. It's just that we happened to open basically where we closed the day before. So there was no trace back. And so it was basically straight up movement. And the 2 days combined then are about the same size as this bar right here, which would have been Tuesday. And that was a 0.67% move. Okay, so that if we look at this, the movement on Friday was 0.58. The movement on Tuesday was 0.45. Those two added together, they are more than 0.67, but there is a little bit of overlap. And also, when we were talking about bigger numbers, a smaller percent is a larger absolute. So overall, these 2 days are about the same as this one day. And I wouldn't get too excited about this just yet. When we look at deeper into the market, we can see a few things that are a little disconcerting. Number one, all of this movement is on low volume, low volume. So everything that creeped up on the previous week was a low volume environment, and we can't entirely trust it. Institutions were not participating. It was mostly retail traders, mostly algorithms. And associated with that move upwards was VIX. VIX moved upwards as well, which is a little bit unusual. And what it says is we don't have a lot of certainty about that movement upward, especially since, or mostly because, there wasn't that institutional participation. If we had institutional participation, if we had a significant amount of volume, that would be a different story, but we didn't get it. We are looking at a little bit of heightened risk in the overall markets. We'll take a look at that in terms of momentum in just a moment. And that makes me want to put on a volatility hedge very soon. We've talked about it a little bit over the past couple of weeks, but it looks like we're getting closer to that point where we would want to have a volatility hedge. Maybe tomorrow. We'll see how today goes. When I look at TLT, TLT moved upwards as well. It hit this purple line that we have here. It is possible at this point, because of the data that is unfolding, that we might reach this upper purple line before coming back down. When we look at the CME Fed Watch tool, what we see is that July percentage went back up. It was at 4.7 on Friday. It went back up to 6.7. So this percentage really does need to go to zero. We are not going to get a rate cut on July 31st. I can say that with very, very, very high conviction that it's not going to happen July 31st. However, September 18th is becoming more likely. Is it 73%? Probably not. But after we get some data, it could start to creep in that direction. It has been over the last couple of weeks, 2 to 3 weeks, and depending on how more data comes out, September could be possible. Right now, I wouldn't say it's 73, 74% possible, but it's not insignificantly possible. It's not below 50%, I would say. So July 31st, zero. September, up in the air, 50-50. There is starting to become more and more possibility that it could happen. And we'll take a look at what's coming up in terms of data to see how soon. Well, I guess it wouldn't happen. It would still happen on a timeline, but at least how soon the bond market might start really appropriately pricing everything in. But in any case, this does have to eventually come back down by July 31st. And then depending on what the probabilities are priced into the markets for September, then that is going to start to take over this price action right here. So if everyone starts to think, oh, we start to get better data and forget that July is basically zero, then we could pop up here before coming back down. Let's take a look at our, we really looked at VIX. Let's take a look at our momentum levels. When I go and I look at my overall market, oops, that's the wrong one. All stocks above $2 that have been trading for at least 6 months. Our 50-day MA is back below 40%, and our 200-day MA is at 51%. So we're kind of back in the situation that we had maybe 1.5 to 2 weeks ago, where we have a sub 40% 50-day MA, and we have a 200-day MA that's getting very close to 50%. Once we dip below that 50% on a non-weighted basis, or so basically looking under the hood of the engine, then we're basically at the very beginnings of a bear market. So the definition, classic definition bear market is less than, markets below their 50-day moving average and markets also below their 200-day moving average. It may not look like it on this because it looks like, hey, we're making all-time highs. Why would we even be worried about a bear market? But when we look at the RSP, then we start to get threatened. Now, this RSP is showing quite a bit above the 200-day moving average. So it looks like that we're far away. But what that momentum is telling us is that we're going to start heading down towards that MA200. So that would be technically on the indices, we wouldn't indicate a bear market, but we would be heading in that bear direction. And then we would test to see if that MA200 would hold. Now, is that imminent? Are we at the precipice of the cliff? I would say not quite yet, but we're just seeing the danger signs. Right? Q, also all-time high, QQEV, QQEW. If we look at that, it's looking like it popped above this resistance, also a all-time high. So on the QQQ, the story is matching. What that tells us, though, is that it's tech-driven. All of the action is in those FANG stocks and those really big market cap stocks, and all of those are in tech. So this disparity in the action between the Dow and blue chip stocks versus the tech stocks is widening. And we cannot have a true bull market if we don't have the participation of the Dow Jones. Dow Jones is still the classic indicator of the markets and the economy. It's Dow Jones Industrials, because industrials drive the broad economy. Tech drives growth, drives innovation, but industrials drive the base economy. So we need to have a little bit of a pullback in order to relieve that disparity, and then perhaps we'll see, but at that point it's possible that all the sectors or the entire economy starts firing, and then we can continue to move up. Until that happens, though, the possibility is very slim. If I look at the Dow Jones, basically we're just chopping sideways. We just made that high up here, and then we chopped sideways ever since. An important indicator or kind of leading the Dow Jones is actually financials, because the financial system is the pulse of the economy. It drives the liquidity. It's the cash flow of industry that allows them to churn and to keep on uh, growing. So if I look at my financials, that looks almost exactly the same. Right? If I look at DIA, all I did was, it looks like all I did was shift that scale a little bit when I go to financials. So until we see those financials participating and pop up, and then Dow Jones pop up, we're in a situation where we really do need that pullback. That pullback, hopefully to the MA50, is appropriate. That's roughly 5%. And then if it goes deeper than that, if we end up requiring even more in order to get everything in line, then that's down to the MA200. That's about 12%. So we're looking at correction territory. That's all appropriate. And what we were talking about in that RSP, where everything starts heading towards that MA200, which looks kind of far away, but really is not that far away. It's only 4% away. So that's the same as a pullback in the SPY. So that starts to relieve that disparity that we're seeing in the momentum levels over here. So at some point, relatively soon, we're going to expect that pullback, that same pullback that we had earlier right here. We're going to expect that to come down. So if we look on the RSP, you can see that pullback pulled us down to that MA90. We recovered, and we're still at this collection of moving averages right here. And then since we didn't go up or make a new high, then we've come down and perhaps make a new low and hit that MA200. When we look at the rest, let's look at the indices. S&P 500, I've got only 44% above the 50-day moving average, 65% of the 200 above the 200, which is looking much better. That's why the SPY, you can see, is significantly above the MA200, or sorry, RSP. It looks like it's fairly significantly above the MA200, but it is below that MA50, and we are kind of squiggling back and forth across it right now. But at this particular moment in time, it is below. So that story is matching the momentum levels over here. And it doesn't mean that, well, what it basically means is that normally we expect the shorter moving averages to play catch up with the longer moving averages. But in this case, we are expecting the opposite. We're expecting the longer moving average to come down and meet the shorter one. Now, our best opportunities are when the shorter moving averages revert to match the direction of the longer moving average. That's not the case that we have right now. That would be the bull case. This is currently, we're looking at a bear case, the longer moving average coming to agree with the shorter moving average. So basically, what we're saying is that this, make it more obvious. This is heading down, and that MA200 is very steady, and then the MA50 crosses it, and then you see that the MA200 starts to come and match it. Now, this wasn't a real bear, so in a real bear, this would happen. The MA50 comes down, and then it goes way down, and the MA200 starts to come and match the same movement, and this is a bear market. And what happens in the meantime is what is the best opportunity is this. The MA200 is up and the MA50 is down, but then the MA50 reverses to match the MA200. That is a very bullish. So this action right here was a very bullish movement in the RSP. Okay. So right now we're looking at the longer one coming down to match the shorter one, and that is a bearish case. It's not all doom and gloom though, because right now, for now, we're only looking at a pullback, MA50. Okay? If we come back just to the MA200 again, that's strong, but not lasting. We would still have the same concerns of pulling back to the MA50. When we look over at the rest of them, we look at our Russell. Russell is in worse shape. 35% MA50, 48% MA200. So what we're seeing is that our riskiest stocks, they're already taking this bearish action. And it might bleed into the next category, which would be the tech and QQQ, and that would bleed into S&P 500. That's normally the case. QQQ is super strong right now. What it's telling us is that all of that strength is really concentrated in some very, very specific sectors. And what we see right here, if we just look at this 50-day MA, I can't highlight just this column, but look at weak, strong tech, weak, medium, somewhat strong communication services, which is also tech, utilities, weak. So it's all in tech right now. And more specifically, it's all in semiconductors. So once semiconductors starts to falter, then it is very likely that the rest of it comes down with it. If we look at our Dow Jones, we got 53.63. That's a little bit better. And then our NASDAQ 100, you can see it's 65.64. So this is looking on the surface looks very healthy. But when we take it in the context of this, then we start to see, we're in a little bit of trouble right here. So if I look at NVDA, which is basically leading the SMH, hit that all-time high and then just drifted sideways, consolidation. In order for us to have confidence in continued upward movement, it would have to break that all-time high. And so far, it is struggling to continue to have upward momentum. If I look at the SMH itself, it looks almost the exact same. It is a little bit better in the last 2 days than NVIDIA by itself, but overall it's struggling right here. So I personally definitely would not go long any semiconductors. I might consider shorts in semiconductors that are weak, but I definitely wouldn't be going long in semiconductors right here. And right now the entire markets are kind of hinged on basically exactly this action. Are semiconductors so strong that they can pull up every single other sector, or does semiconductors collapse down to where all the other sectors are? The answer is it's far more likely for semiconductors to come down and match all the other sectors than it is that it's going to carry all sectors upwards. Can it do it in the very long term? Yes. Well, we just sort of talked about this before. There's this quote unquote revolution, and that when we spread this technology, then all industries improve. If we bring AI to the healthcare industry, it makes it faster, easier, cheaper for us to come up with new drugs. If we bring AI to manufacturing, it makes it faster, easier, cheaper for us to manufacture things. Yes, but that's really far down the road. And this type of event has been brewing over at least since the dot-com era. So there's actually nothing really new about AI. It's just an extension, a continuation of the tech that we already have. It's not like a just sudden burst or change that we didn't have before. We've had computer programs and algorithms analyzing DNA molecules, protein structures, drug structures, SETI, the search for extraterrestrial intelligence, out in analyzing stars. All of this we've had for decades now. It's just that we're talking about it more and more in the news. It's hit some sort of critical mass for us to really get excited about it. So is it going to lift all industry and all sectors? It has been. It's just maybe we hit that a little bit faster right now. That's what we're talking about right here. So this is very unlikely, especially in the short term, to pull all the sectors upwards. It's just probably not capable of doing that, and most likely we're going to have this pullback in the semiconductors. So we're just going to watch very carefully and be ready for a pullback. So first, a reversion to the mean, back to the EMA 8 and the EMA 20. So far, we're not that far away from it, but we don't have to get super far away from it in order to revert. So you can see right here, we kind of accelerated away from that EMA 8, and then we just consolidated sideways until the EMA 8 touched it. Then we reverted down to the EMA 20. Maybe it takes a week to do that, just like it took a week to do that, or 2 weeks to do that over here. Or we could just pull right back. It just depends. What we want to do is watch the institutions. And the institutions so far have really mostly been sitting on their hands, and we haven't gotten volume. Once we get volume, which might not happen all summer, by the way, once we get volume, we'll get clear directional movement, which also means volatility, but volatility is opportunity. If you don't get volatility, then what you have are like currency markets. I guess currently that's not a great example because Japan has really been, they've been messing around with their interest rates. So if I look at here, you can look at this scale. Okay, it looks like what we were just looking at. And you're like, Kane, what are you talking about? This is volatile. It's moving up. It's moving down. But look at the scale of it. This low right here is 0.9165. And this high right here is 0.9431. So what we're talking about is 0.027. 0.027 cents, not even percent, 0.027 cents. And this is less than $1, so it's even less than 0.027%. So this is actually the volatility. If I were to put this up next to the SPY, what you'll see is this. All right, actually, maybe I'll do it. Let's put the SPY here. See? Flat. Movement. Flat. So volatility is what gives us directionality. Without that volatility, we just chop sideways, and we're seeing that in the S&P right now because we have that VIX that is just super low right now. And what's happening with the SPY? Well, RSP, chopping sideways. If it weren't for those few FANG stocks, we wouldn't be doing this. And even with those FANG stocks, we're having these periods of where we're just chopping sideways. So when that volatility comes in, we can get some directionality. Right now, the current directionality more likely is a pullback to that MA50. We've never looked at futures today. Let's take a quick look at futures. We've got the S&P up. Oh, this is all random. Yeah, all random. So upward bias so far in the morning, we've got about 10, a little over 10, 12 basis points on the S&P 500. We've got not even 10, so about 8 basis points on the NASDAQ. And then we've got the Dow with the most significant movement at about 20 basis points. So we were getting a little bit of that correction that we've talked about, where the Dow is actually moving less, far less than the NASDAQ is moving far less than the Dow. So we're starting to see signs of a little bit of correction. Although right now this is all upwards, it's randomly upwards. And we're just going to see how that develops and when do we start moving downwards. If we look at our economic calendar, we've got nothing going on today. We've got Powell speaking tomorrow. I doubt that'll change anything. And then we've got Wednesday, nothing really going on. Thursday, we've got CPI. Friday, we've got PPI and consumer sentiment. But in light of CPI, PPI, consumer sentiment is probably not going to be that meaningful. CPI, PPI, that'll give us more data, more clue on what the Fed might say or do. And Thursday actually is the beginning of earnings season. And this earnings season is the first time where the revisions for the corporate earnings has been upwards. Ever since COVID, basically, we've been revising them down. Oh, our expectations for our companies, there's less, they're under pressure. We're going to understand that they're having a hard time. And so we revise their earnings down, and then that makes it super easy for these companies to beat earnings and for us to get these upward spikes in price because they quote unquote beat earnings. Right now is the first time where the earnings are revised upwards. So it actually makes it a little bit harder for these companies to match those earnings expectations. And it's happening at a time where we've had a lot of announcements of layoffs. I don't know if you guys remember that, but about a month or a month and a half ago, there's a lot of news about Google's laying off, Amazon's laying off, all these people are laying off. Okay. Does that make it more likely or that they're in a good situation, or less likely that they're in a good situation? They're laying off because they're not optimistic about their economic prospects. So is laying off and cutting costs enough for them to match an earnings report? Well, that's a way to preserve your profitability, not a way to preserve your net earnings. So we might have some surprises. And if we have surprises in the corporate earnings to the negative side, then that could be the catalyst that starts to bring us down towards a pullback. We're less than 2 minutes away from the market open. I've talked way too much today, so I'll leave it there. Have a wonderful rest of your day, and I'll see you in the post market.